After this session, we are hoping that you will be able to understand what resume is much more beneficial to you so that you can choose perfectly. Also, we are going to look upon the tax saving opportunities, the tax saving instruments that are available to you under new regime as well as the old regime. We will try to understand them, and we will uh, we will go through them. We will go ahead with them, and we will try to understand, and we will try to implement those as best as possible. Fine, that is great. Now, so before we move, let's look upon what is the agenda for today. Today we are going to look what is the new regime and how, after your declaration, whether you are going to be taxed under the new regime or the old regime, how your employer is going to deduct the taxes, and how what are the options available to you under the old regime and the new regime, so that you can take those benefits much more efficiently. Further, we are going to look upon uh, some of the opportunities, some of the allowances that can be a part of your salary, and how you can take the benefit of that, and how you can actually take out the salary, take out the tax saving allowances out of your taxable salary income, and be much more tax efficient. Furthermore, we are going to look upon what are the investment opportunities, what might be the best situation, what are the funds, what are the situation, and what are the things you should look upon while making a new tax saving investment. And upon that, we will try to discuss if any questions you have after the session is over. Okay, great. Moving ahead. Now, first things first, as you know that in the first week of February, our finance minister, Ms. Sitaraman, has tabled the new Finance Act 2020, and during her budget speech, she mentioned that from this year onwards, assessees, the employees, will be having a new option as new regime. They can choose to be taxed under the new regime or the old regime as per their wishes. Now, this has raised a lot of doubts, lot of confusion among the common masses, namely, what will be the tax implication if we go to the new regime, and what was the purpose behind introducing the new regime when we have a perfectly good regime till date. So let's address this issue headlong. Right. So when we were computing your salary, when the tax is being computed upon your salary, there are a lot of components, right? There are a lot of tax saving allowances, tax saving opportunities that you have, and all of those allowances takes a little bit of time. Right, you have to know about the rules, you have to know the calculations, and we will look upon those, look at those when we are discussing about the tax saving opportunities under the old regime. Right, so as of now, under the old regime, there are, yes, lot of tax saving opportunities, but it would take a huge chunk of your time, and it would make the tax filing process a little bit more cumbersome, a little bit tedious, and to be honest, a time consuming process, which, to be very honest, we do not have at this day and age. So to reduce this situation, this time constraint, what she did, she proposed a new regime. Under this new regime, uh, there is no allowances available to you. You don't have to go into the intricacies of tax matters, tax rules and tax laws. You don't have to do that. You don't have to file any additional forms and everything. All you need for your tax filing purpose, your form 16, and done. Put the figures in, and the tax computation is pretty much simple. There are lots of slabs, and income is being computed based upon those slabs. Done. However, by doing that, all the tax saving allowances like your HRA, like your LTA, your professional tax, that is a part of your salary component, most definitely. Also, the standard deduction, the 50,000 rupees, till last year it was 40,000 From this year onwards, it's going to be 50,000. So those allowances are taken out of the picture, right? And obviously, when computing your HRA, when computing your LTA, there are a lot of calculations involved. There are a lot of understanding of the tax law matters involved. So to make your life simple, those things has been taken out. Fine. How also couple of other things is also there, like ATC deduction, your LIC premium payments, your home loan principal payments, all those things that are covered under ATC, that has been taken out as well. Because to be very honest, if you are making those payments, you need the premium receipts and everything, so that you can substantiate your claim at the time of filing the tax return. And if any question arises at later point of time, you would be having all those documents, but again, it makes everything a little bit cumbersome. So removing those deductions and making the tax regime, a tax filing process, tax computation process a little bit more simple, that was the purpose behind bringing this new regime. Fine. But under the old regime, all the allowances are there, everything is there, but then again, you have to compute your allowances, you have to know the law, you have to know the rules, you need to file some additional supplementary forms as well to get those allowances, right? So there are these two things. So under the new regime, tax filing process is a lot more simple. Under the old regime, tax filing process is a little bit tedious, but if certain conditions are fulfilled, and if you are making a substantial amount of investment, new regime will give you a much more benefit, and those benefits we will try to understand in a deeper context at later point of time during this seminar, during this session. All right, fine then. Now, another question that arises, that how am I going to, being an employee, how am I going to declare my income to my employees, and how the TDS is going to be deducted, and how how I can choose the regime at the file of tax filing. All right. Now, at the very beginning of the year, it's your duty to choose the regime, whether to go with the old one, whether to go with the new one. Now, as of now, CBDT has come up with a circular. CBDT means the Central Board of Direct Taxes. Now, CBDT has come up with a circular saying that the default situation would be the old regime. Until and unless you, the employees of the organization, clearly mention that I want to be taxed under the new regime, the employer will start to compute the taxes, deducting the taxes under the old regime. Right. However, a lot of question you might be having right now is, let's say at the beginning of the year, I do not hold any investment. I don't have any tax saving instrument. I don't do any tax saving stuff. Now, at later point of time, I start investing into tax saving instrument. Maybe I have taken up a term insurance policy, or I start investing in ELSS. That's a very good tax saving instrument, to be very honest. Now, what will happen then? I have chosen the old regime, new regime. Will those investments go to waste? Actually, they will not. Why? Because at the time of declaring your income, declaring your investment and everything, you are letting your employer know that I need to be taxed under the newer regime. Right. However, this is not a concrete selection. At the time of filing your tax return, you can switch back to old regime. However, since you have chosen the new regime, you have chosen to be taxed under the new regime, your employer will start computing your taxes and withholding your taxes as per the new regime. Fine. However, you have the option to choose or switch back to the new regime or old regime, whatever the situation may be, at the time of filing the tax return. Fine. During the year though, you do not have the option, you do not have the opportunity to switch it back. At the time of filing the tax return, yes, you do have that, but at the beginning of the year or during the year, you do not have the luxury to switch back the options. Now switching these options is will be having a really great impact on your tax computation and your take-home salary. So I would suggest you take your time understanding both the regime and declare it to your employer, so that you don't end up having lesser amount of money in your hand during the month, during the year. Fine. All right. Now let's see what are the tax saving opportunities available under the new regime. Right. So as I have said, under the new regime, there are a lot of tax saving instrument has been taken out of picture, because they involve a lot of computation, they involve a lot of understanding of the tax matters, tax rules. Also, they might involve some sort of investment submission, proof submission and all. If you do not have that, if all those things are not made available to you, so you don't have to do the computation, right? So there goes a cumbersome part out of your picture. However, there are still certain benefits, still certain tax saving instrument available to you under the new regime. Let's look at this. First things first, your employer contribution towards NPS. Right. So if you are having a NPS, all right, the National Pension Scheme, and your employer is contributing in the NPS on your behalf, that tax saving benefit is still available under the new regime. Right. So how this works? You might be asking how this works. So this works in a way that your basic salary and your dearness allowance. Now, I understand that many of you do not have the dearness allowance as a part of your salary structure. In that case, it will be the basic salary only. So your employer will withhold a certain portion of your basic salary and deposit this amount into NPS account on your name. Fine. So what is the percentage? Now the maximum percentage that is allowed is 10%. So if your basic salary for the year is 10 lakh rupees, your employer can withhold up to 1 lakh rupees in your name and deposit in NPS account. Fine. So if you choose new regime, this amount, this NPS contribution will be reduced from your taxable salary. Fine. Now moving on. There are a couple of tax saving investment as well. Now you have to understand that these tax saving investment and tax saving allowances, they are tax free at the time of your retirement, right? So if you are withdrawing the money from your PPF, your public provident fund, your employer provident fund or NPS, these are generally tax free if you withdraw this money at the time of your retirement. So let's say you are changing your jobs, all right, or you are not really ending your career right then and there. On that context, if you withdraw the money from your PPF accounts and all, it will be taxed. But if you, after completing your tenure, your employment with one employer, and you come up with a plan, a business plan that I am going to open up a new startup business, in that case, you are not continuing with any employment. So on that case, whatever amount you are withdrawing from EPF, that becomes tax free. Fine. Same goes for the leave encashment and the gratuity. Now, some of the companies, if there are a concept called earned leaves, right? So if you have earned leaves and you have a exhaustive balance, you have some balance accumulated, you can, at the time of your retirement, you can sell off those leaves, and you can get some amount back from your employer. Those amounts are tax free at the excuse me. Those amounts are tax free at the time of your retirement. However, again, if you are switching your jobs, then it should be taxed. It must be taxed. Same goes for the gratuity. If you are leaving your job, and if you are contributing, rather you are continuing with a company with 5 years or more, then whatever amount you get as a gratuity at the time of your retirement becomes tax free. However, uh, if you are just switching your jobs, ideally it should not be. It should be falling under the purview of taxes. It should be taxed. All right. Now, moving on. Let's look upon what are the tax saving instruments available to you. Now, in this case, I would like to continue our discussion considering everything as your tax saving expenses and tax saving investment. Now, why is there is a need? Because there are a couple of expenditure during the year you incur that does not lead to your investment. That usually goes towards your expenditure. However, if you spend the money in some specified manner, that can be reduced from your taxable income. Furthermore, if you are making some sort of investment, that also can be reduced from your taxable salary. What are those? Okay, let's tackle it. Let's try to understand them in lucid manner. All right. So, excuse me. First things first, the EPF. Now, EPF is a very common thing. Your employer withholds around 12% of your money from your basic salary and DA, and deposit that money in your name into PF account. You will be having some sort of PF account. You should be having UIN, and on that account, in your name, your employer starts contributing the money, and these falls under investment and tax saving investment. Furthermore, what are other investment? Your LIC premium. If you have taken a term insurance plan, then whatever premium you are paying towards keeping this life insurance policy in force, intact, valid, that becomes your tax saving investment. And whatever amount you are paying as premium, that can be reduced from your taxable income. Now let's look upon what are the tax saving expenses. First and foremost, the biggest tax saving expenses is your principal on home loan. Many of you have taken a home loan, right? You are living in a your own self-occupied property, your flat or house, whatever the situation may be. Now, if you have taken a home loan for that, the principal portion of that home loan repayment is eligible as tax saving expenses. You can reduce this amount from your taxable income. Interest portion, that too is tax saving expenses. However, that is treated under a separate head of income. If you are paying the interest portion of the home loan, that usually gets treated as loss from house property, and that is categorized as loss from house property, and that gets set off with a salary income. Fine. Now, another tax saving expenses is your children's education fee. Now, children's education fee usually up to class 12. Whatever amount you are paying for your children's education, that can be reduced from your taxable income. Again, this is a very good tax saving opportunity for you. If you have not exhausted your ATC limit, then I would strongly recommend to go for this children's tuition fee. Claim this amount from your taxable salary. You can reduce this amount from your taxable salary, and it can lead to a huge tax saving benefit, and it can help you to utilize this ATC limit of 1,50,000 to its full extent. So if you are not considering this, if you are not declaring this, I would strongly recommend you consider this and start to show this as your tax saving expenses. All right. Now, what are the other things? Fine. One of the things is, again, it goes towards your wealth building. It goes towards your investment. It does not really resonate with your tax saving expenses. That is your pension plan. Now, if you have taken a pension plan, because most of the private organization, they do not really offer any pension plan. If you are taking a private pension plan from LIC or any other insurance companies, then whatever amount you are paying towards keeping this policy, keeping this plan into force, that becomes your tax saving allowance. Again, tax saving investment. So again, if you are not taking any insurance plans, your pension plans, I would strongly suggest to go with a pension plan so that your wealth can be built and you can have a tax benefit as well. All right. Another thing that has a really huge impact in respect of your tax saving as well as your wealth building, that is your ELSS, that is your equity linked savings scheme. This is a mutual fund, a specially designed mutual fund, specially curated mutual funds that has a tax saving benefit that falls under your ATC limit. Also, if you invest in these ELSS funds, then you are building towards a secure future because your wealth is going to be built, right? So if you have not considered investing in ELSS, I strongly recommend you consider this ELSS. Also, during this time, the position of the market is little down, so you can get a lot of units for your money's worth. This situation, this turbulent situation is bound to pass in some time, most definitely, and market is going to pick up. So at this time, if you are investing in mutual funds, then it can give you a huge amount of benefit at later part of your time. All right. Now, many of you may ask, how do I choose a proper ELSS or mutual fund in general? So in that context, I would suggest look at the past performance of the mutual funds and try to invest in the mutual funds which are having a strong balance sheet. Also, you should look how the fund manager is managing. A reputable fund manager is the way to go. A mutual fund who has a strong balance sheet and a reputed fund manager, most definitely you can go with that mutual fund. Fine. Now let's look upon what are other tax saving instruments available to you. Now we have talked about your employer contribution towards NPS. Now we can talk about your contribution towards NPS. How this happens? Now let's say you want to invest in NPS. Usually whatever amount you are investing towards the NPS, that falls under ATC limit, right? So if you are investing in this NPS, initially this amount will be counted towards ATC limit of 1,50,000 rupees. All right. However, if you are investing in NPS, the government understands that and understands that you are trying to build your own secure future and they want to give you a little more benefit for your investment in NPS. That's why they give you additional 50,000 rupees in NPS. So if you are investing in NPS and if you are having any other investments, then your limit, theoretically speaking, becomes 2 lakh. Now how this happens? Let's understand this matter with an example. All right. Now let's say you have your you have taken a home loan. For that home loan, you are paying a principal amount of 1 lakh rupees. All right. You have taken a pension plan. For that, you are paying 50,000 rupees. Also, you have taken a NPS plan. For that, you are paying 50,000 rupees. So in total, your tax saving investment comes to 2 lakh rupees. So how this will be counted towards your ATC? Firstly, that 1 lakh rupees of home loan principal, that will be going towards your ATC bucket. Secondly, your pension plan, the normal pension plan from any private insurance provider, the 50,000 rupees will be going towards your ATC limit. And remaining 50,000 rupees that you have in investment in NPS, that will go towards additionally under a different section. So if you are investing in this manner, in whatever combination possible, you will get the entire benefit of 2 lakh rupees. Fine, great. Now, what are other benefits that is not covered under 80C? However, they can still go towards your tax saving investment. First and foremost, the biggest thing is there is your 80D, that is your medical insurance payment. So again, if you have taken a medical insurance and you are paying a premium to keep it in force, whatever amount you are paying to keep it in force goes towards your 80D, that is your medical insurance payment. Now, in medical insurance under 80D, there are two segments. Number one, whatever amount you are paying for you, your spouse and your kids, and number two, whatever amount you are paying towards having a medical insurance for your parents. Now, if your parents are senior citizen, then the maximum allowable amount for medical insurance is 50,000 rupees. For you, your spouse and your kids, the amount is 25,000 rupees. That is the maximum amount. So again, let's take a situation, let's take an example to understand this matter in a better way. Let's say you have taken a medical insurance for yourself and you are paying 15,000 rupees as medical insurance. You have taken a medical insurance for your parents who are senior citizen and you are paying 35,000 rupees for that. So how much can you claim? 15,000, the entire amount for you, your parents, your spouse, and 35,000 rupees for your parents. Now, situation may occur that some of the insurance companies will not be willing to extend medical insurance premium policies for older people. So in that case, what will happen? Will there be any benefit? Will there not be any benefit for them? Most definitely not. If your senior citizen parents are not covered under any medical insurance, then any amount you spend for their medical expenditure, that can be claimed under 80D. Now, one thing you have to remember, if they are covered under medical insurance, then their medical expenses will not be covered. If they are not covered under any medical insurance, then only their medical expenses will be covered under 80D. Alright. Now, what else? There is 80DD, medical treatment for your dependent who are differently abled. So, there is a certain percentage for disability. If that disability is 40% but less than 80%, that is, they are not severely handicapped, then you are getting a blanket coverage of 75,000 rupees regardless of the expenditure. If they are severely disabled, then this amount is 1,25,000 rupees regardless of the actual amount you are incurring. Fine. So if someone who is not severely handicapped, their disability level is, let's say, 50%, and you are incurring 40,000 rupees for their medical treatment, you will get a blanket amount of deduction of 75,000 rupees. For the same person, if you are spending, let's say, 1 lakh rupees, then also the deduction amount is limited to 75,000 rupees. Fine? Okay. Now, again, in some unfortunate situations, some of your dependents or you might incur or might suffer from a serious disease, maybe neurological disorder. So in that case, if you are paying for the medical treatment of that person for you or that other person who is dependent upon you, 40,000 rupees or actual amount, whatever is lesser, can be reduced from your taxable income, provided that person is less than 60 years of old. That means they are not senior citizen. If they are senior citizen, this 40,000 limit gets increased to 1 lakh rupees. Fine. Now, all these medical treatment for dependent, or specified diseases, these require a little bit of understanding, because these are tax saving opportunities under the old regime. And as I have mentioned, under old regime, you can take the benefit provided you adhere to the rule, you submit some additional forms. Now, these are those deductions that is available to you, that will be given to you provided you submit certain document. For medical treatment of your handicap dependent or specified medical diseases, you need to have a certification from medical practitioner in a specified forms. The forms is pretty much simple. It can be downloaded from the income tax portal. You can download it, fill it up, signed it by the medical practitioner. However, to avail these benefits, these forms need to be submitted along with the tax returns, and needs to be uploaded in the income tax filing. All right. Moving on. Now we have talked about if dependent is suffering from disability. What happens if the assessee himself or herself is suffering from a disability? Again, there is a benefit for you. However, it is covered under a different section, that is section 18. Again, if you have a normal disability, that means maybe you are suffering from a partial blindness, then 75,000 rupees is the limit. If you are suffering from a severe disability, maybe paralyzed from waist down or something like that, let's hope that this situation doesn't come upon any of you. But if it does, then 1,25,000 rupees is the benefit amount. Alright. Now, again, many of you, after qualifying, let's say after qualifying your engineering degree or any other degree, you are getting a job. However, you are not really happy with the career progression. You want to go for a higher education. And higher education usually attracts a higher amount of fee, and to get that education you need to avail an education loan. If you take any educational loan, interest portion of that education loan can be reduced from your taxable income, and the best part is there is no limit specified. Till now, whatever discussion we have made during the tax saving allowances, that comes up with a restriction that till this amount you can have this deduction, beyond that you cannot claim any of the deductions. But this particular expense does not contain any of the limit. Whatever interest you are paying, you can reduce it from your taxable income. Okay. Now, we have talked about the tax saving expenses and tax saving instruments. These things comes after you getting your salary. But how to structure your salary in an efficient manner so that some of the expenses that you incur in your day-to-day life to perform your duties does not fall under the taxable category. So you can take a lot of expenses out from your taxable income from the very get-go. So you come to this point with a lesser amount of salary. How that can be achieved? Again, there are a couple of things you need to consider, and all these allowances are available under the old regime. Under new regime, these are not available at all. What are these? The biggest thing is your HRA. If you are living in a rented place and if you are doing your duty from a rented place, then a certain portion of your rent can be reduced from your taxable income. This HRA, we all know about it, but there are a couple of things that most of us don't really know or don't really care about. However, all those allowances combined can save you a substantial amount of taxes. These things will actually require you to structure your salary in that fashion. Otherwise, these benefits are not available at all. You need to have these allowances embedded in your salary, then only you will be able to take the benefit. Again, this is a little cumbersome process. That is why it is falling under the old regime, and they are not appearing under the new regime. What are these? First thing is your LTA, leave travel assistance, or leave travel allowance, whatever name you want to call it. What happens is, let's say you are doing your job, most definitely, and every single person needs some sort of vacation to work properly. Income tax department understands that. So they say that if you are traveling and if you are incurring the traveling expenses, that can be reduced from your salary so that you can perform your job better way and you can contribute towards country's building. Now, again, there is a saying, travel broadens your mind. That too has been considered as well. So if you are traveling and let's say through air, you are traveling through air, the to and fro expenses can be reduced from your salary, provided your salary have a slab for that, a structure for that. If your salary contains a leave travel allowance embedded in it, then most definitely if you are traveling, the to and fro expenses, the traveling expenses, the plane ticket expenses, whatever, it can be reduced from your taxable income to the actual portion. So let's say your salary does have a LTA allowance, and that allowance is, let's say, 50,000 rupees. Now you are taking your spouse, your kids with you for a vacation within India, and you are paying 15,000 to journey, another 15,000 fro journey. So totally you are spending 30,000 rupees, right? So from your taxable salary, you can reduce this 30,000 rupees because you already have 50,000 rupees of segment in your salary, a structure in your salary. Now, one key thing you have to understand, number one, your salary structure should have it. Number two, only traveling expenses, the airfare or the train fare can be reduced. And number three, whatever amount you are spending, this benefit is available for 2 year in a 4-year block. The 4-year block just started in this year. So if you are traveling and if you are paying a huge sum of money for your airfare, I would strongly recommend you structure your salary in that way so that you can take the benefit, the traveling benefit. However, if you are staying in a hotel, you are going for a meal, or if you are purchasing any souvenirs from your travels, those are not really covered. Alright. Furthermore, couple of other things you can consider. Number one, at this day and age, we are all working from home and we are having a lot of internet expenses. We need to be logged in through our homes using our broadbands and all. So whatever amount you are paying towards it, it can be reduced from your taxable income, provided your salary have a structure for it, it has a component for it. Otherwise, it cannot be availed. Again, once this lockdown is over, you will most definitely be traveling to your office. And if you are having your own car and you are incurring some petrol expenses, most definitely you will be incurring some petrol expenses, or you are employing a driver for it, then a certain portion can be reduced from your taxable income, that is for your traveling purpose, these sort of traveling purposes. Okay, great. So I would strongly suggest at this point of time, you talk to your HR, you talk to your payroll department so that your salary can be structured in this tax efficient manner. Moving on. Another big question you might be having, that yes, all the deductions are there, every single thing is there. However, how do I choose? How do I choose between the new regime and the old regime? How do I do that? Well, there is a concept. We have come up with a concept, that is your tax break-even. Now, what is tax break-even? Tax break-even is a point of your income when you will be in a similar situation under the new regime as well as the old regime. Regardless of the regime you choose, your tax outflow will be the same. Now, if you go beyond that, you will be better off choosing the old scheme. If you are lower than that, you will be better off with the new regime. Okay. Now there is this chart made available to you in the screen, where it clearly says that how much expenditure you should be having to choose between the new regime and the old regime. At the 7.5 lakh level, you should have at least 1,25,000 rupees of deductions. If you are having that, then you are at the tax break-even position. If your deduction is much more than that, much more than 1,25,000, then you are better off with the old regime. If your deductions and expenses are lesser than that, lesser than 1,25,000 rupees, then you are better off with the new one. Right? Now, let's dig a little deep. How this computation come to be, how this calculation came to be. Let's say your total income is 7,50,000 rupees. Your salary is 7,50,000 rupees. Now, standard deduction is 50,000 rupees. That is given. And let's say your LIC premium is 75,000 rupees. Alright, you are paying a LIC premium of 75,000 rupees. Fine. Furthermore, you have taken a medical insurance for you and your spouse. It is giving you 15,000 rupees. So in total, your total tax saving investment is coming to 1,40,000 rupees. What will be the situation? In the new regime, 1,75,000, from there you cannot reduce anything. Your tax liability will come to 37,000 rupees, 37,500 rupees. Now, if you go with the old regime, you will be able to reduce 1,40,000 rupees from your 7,50,000 rupees of taxable income. So it will give us a taxable income of excuse me, taxable income of 6,10,000 rupees. Fine. Now, 2,50,000 rupees, there is no taxes. 2,50,001 to 5 lakh rupees, there is 5% of taxes. That will give us 12,500 rupees. And again, remaining 1,10,000 rupees, it will be taxed at 20%. It will give us 22,000 rupees. In total, 34,500 rupees of tax comes to be. And under the new regime, your tax liability is coming to 37,500 rupees. So if you are having a higher amount of deductions, be it HRA, be it through any other means, be it through LTA, be it through EPF, PPF, ELSS, any other mode, if it is crossing 1,25,000 rupees at 7.5 lakh rupees of income level, then you are better off with the old regime. Otherwise, stick with the new one. Fine. Also, I believe Srikar is sharing the tax computation sheet with you, so that tax calculator with you, so that you can input the numbers that is available in your form 16, and you can see for yourself which is much more beneficial for you, the new regime or the new old regime. Srikar, can you share this this calculator with them? Okay, actually you are sharing. That's a great job. Thanks. All right. So, what are other benefits available to you, and what are the things that are available to you? Excuse me. Sorry about that. So, one thing that is available to you is your NPS. Now, there are a couple of things in the budget and later point of time. There are a lot of things that has come up, putting people under tremendous amount of confusion, that if you are investing through your employer to NPS and superannuation fund and all these things, you're getting a lesser amount of benefit. You might be having this question. Well, this actually is targeted towards a higher earning people who are having a substantial amount of salary. uh, to reduce their tax burden, what they used to do is they used to divert their income through the employee towards NPS or superannuation fund or RPF more than a specified limit. If that was the situation, then there was no cap, no higher amount that can be contributed in these things, in these funds. Now the change has been brought and limit has been set to 7,50,000 rupees. So if you are investing towards NPS or superannuation fund or RPF, then whatever amount you are contributing, your benefit will be limited to 7,50,000 rupees only. Alright, so we are actually nearing to the end of this session. So I would like to answer some of your queries if you are having. So I would, and I think Srikar has been doing an impeccable job answering your queries till now. And if you have any other questions, please let me know so that I can take up those questions. Okay. Ganesh, I think you have raised a very interesting question over there. You asked that house loan with rented house or house loan with own use. Well, the benefit is available for both types of house situation. However, if you have taken a home loan for your own house, the interest benefit is limited to 2 lakh rupees. However, if the house is let out and you have taken a home loan for that, there is no limit on the interest prepayment. However, if you declare this rental amount in your tax return, most definitely your income will be increased. However, if you are paying a substantial amount of interest, the entire amount of interest can be reduced from your taxable house rent, and remaining amount, if again the interest amount is higher, the remaining amount can be set off against your taxable income, taxable salary. I hope that answers your question. Okay, Maria has asked that total CTC is 8 lakh and I have house rent and LIC, which regime would be good? Again, Maria, if you have house rent and LIC, combining these two, you need to see which level you are belonging to. Most definitely, you will be belonging to that 10 lakh bracket. All right. So in that situation, I would suggest you to use the computer, our clear tax calculator, to come up with the better figure. But going by the headline, I think old regime should be better suited for you. Ravi, if you have one house and you have let it out, and if you are actually legally required to show whatever amount you are having, because if you are getting a substantial amount as rent, your tenant might ask your PAN for it, because obviously he will be willing to take the HRA benefit, and if the government tries to look into the deeper into the situation, then it would be a difficult situation for you. So I would suggest that declare the amount, be in the clear. All right, Sandy. The home loan. I believe you are talking about the home loan for these purposes. And to answer that, the interest component, whatever interest you are paying, that will be accumulated to the point when the house gets completed. In a year, you get your house completed. From that year onwards, whatever amount you have accumulated can be reduced in 5 equal installments. The principal component, during the construction period, you cannot take any benefit of it. However, the principal component can go towards the cost of the building, cost of the house. And at later point of time, if you are willing to sell that house, that can increase the cost of the house and that can be reduced from the selling price. Okay. Venki Money is saying that whether the existing insurance cover COVID. Well, as of now, the government have come up with a circular that existing insurance, medical insurance, should be covering COVID. If not, then add-on insurance premium can be taken so that your COVID medical expenditure can be covered. Well, Rahul Jha, uh, in this situation, it's better to show, since there are co-owners, it's better to show 50-50 or whatever percentage the house is in both of your name in the respective tax return. Because if your wife, or if one of the person is having a job and other person is not having a job, it can be clearly substantiated. You are trying to, one of the person is trying to avoid the taxation. So in that case, it is advisable to split the amount in two halves and show them in the respective tax return. Well, Shatodru, again, that's a very good question. Yes, most definitely you can do that. You can split the HRA in 50-50 ratio between you and your spouse, and both of you can claim the HRA benefit. Most definitely you can do that. Well, a lot of questions are coming in. Well, Ilroli, sleep disc treatment under 80 dB. Actually, under 80 dB, sleep disc treatment is not really covered. There are specified diseases, and there is some extensive diseases. There are, although sleep disc is not a matter of joke, to be very honest, but I'm afraid it is not covered. Well, Karthik, most definitely you can invest in PPF and NPF beyond the tax deduction limit. That is entirely your call, and you will be getting some benefit, but there will not be any tax benefit. Shatudru, it will not attract double tax because you are splitting this amount between you and your spouse. So it will not attract double tax. No. Well, Rashmi, based on the figures you have provided, I would say stick with the old one because under newer one you will not be getting these ATC benefits or HRA benefits and all. But to get a better understanding of the tax saving, I would suggest visit our tax calculator. Yes, Rahul, if your father is a senior citizen, then any medical expenditure amounting to 50,000 rupees, limited to 50,000 rupees, can be claimed provided he is not covered under medical insurance. And as you have mentioned, he is not covered under any medical insurance. And assuming he is a senior citizen, the entire 50,000 rupees can be claimed. Yes. All right, people. I believe we are at the end of our session, and hopefully, you have taken some notes during this session. Hopefully, you have taken some ideas how to save the taxes, how to structure your salary so that you can take a maximum amount of tax saving benefit. Let's utilize this thing and stay home, stay safe, and if you need any tax assistance, we are always there. Thank you for your time. Have a great day. Bye bye.